Hi, good evening, ladies and gentlemen. It's evening on my end. It's been the end of trading in London as well as on the Nigerian market. A pretty historic day. I would delve into that on my Spotify episode. So if you're not following me on Spotify, do listen, like, share, subscribe when you get there. I'll have the details at the end of this video. So today I'm looking at Cutix numbers. Preparation for this video was it took me a bit longer than normal, and you see the reason why once I get into the figures. Now, Cutix was incorporated on November 4, 1982 as a private limited liability company. And if you're watching on YouTube, I'm sure from the cover of the video you can see the different pictures of the products that they make. So Cutix is a firm that makes electrical products, cables, wires, cables, conductors, and the like. So incorporated November 4, 1982, listed on the NGX 1987, and migrated to the first year in 2008. Company is based in Nnewi, Anambra State. So now in my forecast, as you can see from here, I've tried to forecast how I think FY 2026 will shape out for the firm. Now, Qtix runs, I would say, a rather odd financial year. So they don't run the usual January to December 12-month calendar year. I think the calendar year for them ends, I think, either March or April. I'd have to confirm. And maybe I'll drop it in the comment section in the video. So FY 2026 forecast 25 kobo in earnings per share. Current price as of today, 4 naira 26 kobo. You divide 4.26, that's the price, by forecast earnings per share. You get the price to earnings ratio. And the price to earnings ratio, also known as PE ratio, essentially tells you how much more investors are willing to pay for a firm. So if a firm makes, say, 25 kobo in profit and investors are paying 4 naira 26 kobo, it means that they're willing to pay 17 times the company's profit. And why is that the case? Or why would that be the case? Now, if it's a case whereby I think this firm is going to be growing at, say, 20-30%, then that would make sense. So that's how PE ratio works. Now, my target PE ratio for this firm is, or my target price, which is about 10 times earnings, comes to about 2 naira and 50 kobo per share. So potential downside, if you are going to go just by where it's currently trading at, would be 70.4%. However, I've opted to include a different approach, or another way of valuing the firm. And if you're going by dividend discount model, and I've explained in detail in the next page, I have a model of about 3 naira and 0.3 kobo. So that's 3 naira 3 kobo. And in that case, the difference between where the stock is trading at and where it is in terms of dividend discount multiples is about 28%. So my view is a hold. And why is it a hold? Simple. A hold because we are in a bullish market, a strongly bullish market. So it wouldn't make sense, in my view, selling the stock. Second reason is audited full year numbers are yet to be released. The last numbers that were released are Q4 2024, or full year, if I can use that word. Full year actually unaudited numbers. So we need to have the audited numbers. I think audited numbers very likely could be out sometime this month. So that will give a truer picture, even though from my experience with firms like this, a lot of times you don't have much difference between the audited numbers and the unaudited numbers. But to be conservative and to be prudent, you essentially would want to see the audited numbers. You essentially would want to see the first quarter numbers. And but management, and I must give them kudos for that. Management has given a forecast for the second quarter, and they've kind of also hinted at what the first quarter numbers look like, because they've told you you're not going to have much variation in terms of that. So I had initially added where I had all my numbers on my Excel sheet. But what I would do, because I'm seeing that I've cut that out, what I'm going to do is I'm going to have this article. I'll make an exception, and I'd have the article up on the Green Ticker Tales website. So where there you can see where essentially what I did is to say, look, took the Q2 forecast, took Q1 numbers for the previous financial year, put those two together, multiplied by 2, and then that gave me my number. So I'd have the written article up on the Green Ticker Tales website, or maybe up on my Substack, or both of them, sometime tomorrow morning Nigerian time. Now, so I do have, however, my dividend discount model valuation, and it's quite simple. I also prefer to use it. This is my preferred way of valuing a firm if the company pays dividends. So FY24 dividends was 15 kobo. I've modeled the growth rate. I think that the dividends should grow by some essentially what I have a 1.01. So if you add up all the numbers together, you get 3.03. Now, I wish I was using Excel, but unfortunately or fortunately, Canva happens to have better aesthetics than Excel. And so if I was using Excel, probably let me know what you prefer in the comment section. Videos with cut and paste into Canva, or would you prefer the videos in Excel? I mean, I personally like the Excel, because that way I can tweak the numbers and people can see, and can see everything. So essentially, dividend discount model DDM makes it easy to value firms. It's quite suitable for firms that pay dividends. So all you have to say is to say, look, firm paid 15 kobo in dividend. I think the dividend growth rate will be 0.1. My required, which is 10%, required rate of return 15%. Now, the only downside to this model is that your required rate of return has to be higher than your dividend growth rate. If it's equal, or if the dividend growth rate is higher, then you just render out the model virtually, unusable. So that is the only downside. But you can always tweak it. Probably let me see if I can probably do a video with Excel and include it into my article and put it on the Green Ticker Tales website. So do check out the website sometime tomorrow for that. So if you took these numbers, and I've tried to lay out the method of using this valuation style. You have the expected dividend, and then you have R minus G. So my expected dividend is a 0.1515, and then my R minus G, R being rate of return 0.15, G being 0.1, that gives me 0.05. So if I take 0.1515 and I divide that by 0.05, it gives me 3.03. Now, if you want to work it out on your own, and you can do this as well if you have the spare time and you are mathematically inclined, all you need to do is to say, look, adjust your required rate of return to maybe 20. Then you can adjust your dividend growth rate, or you can actually leave your dividend growth rate as it is. So that could be 0.1. So if you take a 0.1515 and you divide that by 0.1, that will give you what? A 1.5. So if you play around with those numbers, I mean, this is what you'd arrive at. You could arrive with maybe a 2 naira or 3 naira or 4 naira, as the case may go. So in any ways, I mean, let me know what you think in the comment section if you have an alternate view. As always, you want more content, like I promised, I'm making a promise, I'd have the Excel sheet up on the Green Ticker Tales website. And then I would also see if I can have a separate video and embed that video where you can see me playing with the different scenarios, and where you can see where I added, my arrival at the full year earnings by trying to splice and cut and dice the different quarters available for the firm. I just occurred to me, and maybe I would add it into the article. Another way to look at it, I think, and if my math is correct, I would have to cross check my books and confirm, is to say, look, what's return on equity, and I mean, typically that's where I would use it for banks. But in my view, we can play around with this. Another way would have been to say, look, what is the if you took the market cap and you subtracted debt, you get the EV, and for that, refer to my video on UAC. So I guess if we apply that, so, I mean, I could play around and let's see what the numbers I get are. So keep an eye on the um, website for the write up on this. So I hope you found this useful. Do let me know and have yourselves a great trading day ahead. It's still trading in the US, and I'll be dashing to go cover the remaining hours before the US market closes. So have yourself a great day ahead and let me know what you think in the comment section.